Hello, everyone. Welcome back to my channel. So, in this episode, I'm going to talk to you about risk management. This will probably be one of the most important videos I have made to date because if you don't have a proper risk management strategy, you might as well be just going to the casino and gambling all your money away. So, making money in crypto is the easy part, but keeping all your gains is the hard part. So you have to have a proper risk to reward strategy and you have to stick with it. Because I've seen it many times before. People open up a futures trading account and they throw in $100 and they risk all their money on their very first trade. They move their stop loss as close as they can to their liquidation price, and boom, all their money is gone. And then a few days later, they throw in another $100 and they do the cycle all over and over again. So listen up, we're going to go into great detail and I'm going to show you my risk reward strategy and how it works for me. Okay, let's dive in. So as you can see in this diagram here, this is the math of market losses. So like I said, it's very easy to make money in cryptocurrency. The hardest part is to keep it. So listen up. If you lose 10% of your portfolio, you have to make back 11.1% just to break even. And trading is a zero-sum game. So as we move on down this graph here, you'll see it's exponential. So let's say, for example, 50%. If you lose 50% of your portfolio, you have to make back 100% just to break even. So for example, if you had $1,000 in your portfolio and you lost 500, so you're only left with 500 to trade with. So you have to make 100%. You have to make another 500 to get back to 100%. You have to keep this in mind. Cut your losing trades as quick as you can and let your winning trades ride. So in my risk to reward strategy, I like to stick with a risk of 3%. Now, I sometimes might go lower, but I never go higher than 3% of my net portfolio. So for example, say if you wanted to start off your trading account with, let's say, $1,000 and your risk is 3%. So 3% of $1,000 is equal to $30. So that's the max you're going to risk on each trade. So let me break it down. Okay, so say this white line here is where you enter the trade. So you enter your trade, you enter $100 and you put your stop loss down here. So you're risking, so if you get stopped out, you end up with $70. So your risk is $30. So when you take profits, you have to try and aim for a high risk to reward ratio. So if you went for a 1-to-1 risk to reward ratio, so you're risking 30 and you take profits at this TP point. So you take profits at 130. So you get back a $30 profit. So you're risking 30 to gain 30. Now this risk reward isn't really that great. Same with the risk to reward of 1:2. So you risk $30, you take your profit at this TP here, TP2. So you end up with $160. So you're risking a 30 to gain 60. So that's a risk reward is 1:2. And then this scenario, if you take profits at the TP3, which would be $190, you're just risking $30, but you aim to profit $90. So this is a risk to reward of 1:3. So if you use a risk to reward ratio of 1:1, then you need a win rate of 50% just to break even. So every 2 trades that you place, you have to win 1 just to break even. And as it goes to the 1:2, that's 3 trades. If you win 1, lose 2, you need a 33.33% win rate just to break even. And again, we'll go to the 1:3 risk to reward ratio. So out of the 4 trades, you only need to win 1 just to break even, and so on and so forth. So the higher the risk to reward ratio, the less trades, the less percentage win rate just to break even. So it's always essential to aim for a high risk to reward ratio. But the problem with this is it's like a double-edged sword. If you are aiming for, it's so easy for you to say, oh, yes, okay, I'll go into a trade. I'll aim for a risk reward ratio of 1:10. Well, then, if that's the case, then you have to stay in the trade for a lot longer. And price action just doesn't go move up in one straight line in one direction. It ebbs and flows and it comes back. So you have to be very strict with your risk reward ratio. Stick with it. Don't be moving your stop loss. Just set it and forget it. If you want to achieve a high risk to reward ratio, what I like to do is by using the supply and demand method. I made a previous video on how to trade supply and demand. So the best thing about supply and demand is you can use it in all time frames. But for me, I like to stick to the higher term time frames. So let's say the daily chart. So each candle represents 24 hours. So I draw my demand zone here at this red candle. So this red candle is the previous candle before the big green impulse candle. So I'd advise you go back, look at my supply and demand video, and it'll make a lot more sense. So if you're using the supply and demand strategy, you draw your demand zone here. So when I'm mapping out this trade here, so this is the top of the range. We can call this down here the bottom of the range. So essentially, when you're trading the demand and supply, you're only doing business at the extremes of the price action. So this here would be the lower range, the higher range. So since this chart, this is a pretty new coin. It's TON. It was only released a couple of months ago, and it has lots of momentum, right? Topped out here at 257 and is starting to retrace. So with the demand and supply strategy, I'm waiting for the price to come back into my demand zone. And as you can see, this is my lower range. So I'm not doing any trades in the middle because it's just going to chop around. And I don't even know if it's fully going to go back into the demand zone. But if the price comes back into my demand zone, then I know that there's a high probability it will get a reaction from the market and it will pump to the upside. Now, it's not guaranteed, but it has a high probability. Remember, as a trader, we're all just working on probabilities. We don't know the exact outcome. So here I get my risk to reward tool, and make sure you use long if you're going long, short if you're putting in a short position. It opens up in the opposite direction. So for this scenario, we're going to go for the long position. We're going to enter roughly around here in the middle of the zone, let's say. And I'm going to push the target to the top. And I'll just put this stop loss just underneath this previous wick here. And I'll aim it for about roughly around 5%. Maybe, 5.1. And that would roughly be around $30 risk. Now you can go to your risk to reward calculator. You can calculate how much percentage does the price have to drop in the previous direction for the amount of money that you're going to lose. I might make that I'll go into that into further detail in another video. But just for this exercise, you can see that if my target's up here, my stop loss down here, and this is giving me a risk to reward ratio of 10. So that's a 10R trade. So that's 1:10. Oh, well, it's actually 10.8. So we could nearly call that nearly like 11R trade. And even if it just broke out, even if it just made a break of structure here, you'd be getting over a 10R trade. So that's how you aim for a high risk to reward ratio. Now, the only thing with on the daily chart, you won't be trading as much because it takes a lot longer for these trades to play out. While if you went into the 15-minute chart, you can apply the exact same strategy and you'll just be scalping, But for me, I like to just stick with the longer term trading. So I wouldn't be day trading as such every single day, scalping in the market. Some days I might, but regularly I just stick to higher time frame trades. and I just be more patient, and they play out in the long run. So that's how I aim for a high risk to reward ratio. Now, accepting that you're not going to win every single trade, but by sticking to a risk to reward ratio of 1:3 or higher, then you know that you only have to have a win rate of 25% just to break even. If your win rate is higher than that, then that's just all profits. So just go back to the original example here with the calculator. So if your account balance, you start off with $1,000. So divide by that, by your risk, which your max risk that you're risking on each trade, which is $30. So 1,000 divided by 30. Then that means that you could make 33 bad trades before you wipe out your account. But you're not going to do that if you stick to the supply and demand strategy. It has a high success rate. It teaches you to be patient and wait for your trades. And by sticking to a risk to reward ratio of 1:3 or higher, you only have to have a win rate of 25%. Your winning trades will wipe out your losing trades. And before you know it, you'll become a profitable trader. Now, you will notice after time that your account will grow. And for example, say if you start off with $1,000, eventually you'll get to $2,000. So in that scenario, so then if you're still risking 3% of your total portfolio and it has grown to $2,000, then you can risk $60 per trade, and so on and so forth. Now, for example, some traders, what they like to do is like to just to keep their balance maybe 1,000, and they take out the $1,000 profit. They could put into Bitcoin or do anything what they want with it, but that's up to you. You can just keep growing your account. That's your decision. But to make big money in this in futures, you have to play with bigger money. So that's totally your decision. So that's your video on risk management. If you got value out of this, please, you know what to do. Go down, hit the like, hit the subscribe, and I'll see you in the next video.